Do you want to just take us through Stonebriar, if we each talk quickly about your different institutions?
Sure. Stonebriar Commercial Finance, our aviation capital business, is focused on being what I like to call a merit-based lender. So we look at every transaction on its own. We don't have additional relationships with the customer. We're also not a bank. We are a finance company, so we have to independently raise sources of capital, and we do that through both equity and debt. Our geographic footprint has been global. Typically actually a little more outside the U.S. than within because of the nature of more asset-oriented lending. We've been in business now since 2015. We've deployed almost $2 billion of capital in that time period. And the business was formerly known as Guggenheim Business Aircraft Investments before that. And so that's our summary on Stonebriar.
Okay, Emma?
Well, UniCredit is, a very global financial institution, a worldwide operating bank. We have a footprint and a home market in actually 4 areas. This is Italy, our home market. This is Germany. This is Austria and Central Eastern Europe. But not just single countries, the entire region. And of course, also in the Americas, in the Asia, we have also presence. So since we are a commercial bank with a fully fledged also investment banking part, also private banking, retail banking, all the different things, we operate in the business aviation industry, especially from the leasing point of view. So I'm heading the leasing operations in Austria, and we centralized for business aviation our competence center for the entire group in 2 locations. This is Austria in Wien and also in Munich in Germany. So why we are doing that? First of all, of course, to ensure a one voice policy. So we will showing to the market as, let's say, a single approach, and of course to concentrate the entire know-how for the group.
And you're also a proper asset financier. You're not looking for relationships necessarily, are you, when you lend?
Well, business aviation is just one asset, to be honest. So we are doing it from the equipment, from the real estate, from the rolling stocks, from the renewables, etc., etc., etc. There are different asset classes. Of course, we have, let's say, a track record and a backbone in very special asset classes. And business aviation is one really essential part where we are acting. But we are also very keen that we are using this asset class or this business, especially also for our customer base, because our main customer base worldwide are corporates.
Shawn?
Right. So Global Jet Capital is a privately held financing institution. Our ownership is the Carlyle Group, KKR through Franklin Square, and AE Industrial Partners. $2.3 billion in portfolio value. Globally oriented, and the business was stood up early in 2015. We executed a transaction on the GE business aircraft portfolio in 2016. And to this point, we too have deployed about $2 billion.
Okay. What's the market like now? How strong is demand for finance?
Well, we specialize really in the operating lease environment, and I can reference over the last 3 years since the business was stood up, we've experienced 20% growth year over year. The marketplace is responding, remarkably well to the value proposition that Global Jet Capital brings, which is specialist, unquestionably. But our clientele typically may not necessarily want to be further extending themselves in a commercial bank or through their private banking relationships. So they're looking for a knowledgeable alternative who's as focused on that asset and its life cycle value to them as we are.
Nick?
Yeah, I think demand is strong overall in the market. I think it has been now for the last 3 or 4 years. I'd say for our product, maybe not as strong as it was a couple of years ago. And I think as what we've experienced as economies strengthen, as we get to the top of the cycle, the traditional financing markets driven mostly by the banks tend to be more aggressive. And so their rates are more attractive, their structures tend to be more attractive. We tend to see our portfolio grow closer as things kind of are moving through a downturn. So I'd say 15, 16, 17 were very strong years for us. 18 was a slower year, and I expect 19 to continue to also be slow.
Are you hoping for a downturn?
No.
Liar. Emma?
Well, the demand is quite high, I have to say. But for me, above all, it's not just the number and the volume of the demand, it's more also the quality and the sustainability. So if we have a look on the last 12 to 24 months, I agree fully with Shawn and Nick, the demand was becoming on a level where we can almost say it's a pre-crisis level, pre-crisis niveau. But the more positive finding is that also the quality and also the sustainability of the demand and of the requests are really good. So, and this is, I think, the much more positive and important point.
Would you still say, Nick, that your biggest competitor is cash owners buying, or?
And Global Jet. No, cash, I think, is always our competition. What's sort of interesting is if you're tracking what's happening with interest rates over the last 12 months, rates are going up. I think banks have more ability to not pass that through to their customers as aggressively as, say, we do. We have to make an equity rate of return for the people that are backing us. So I think right now it's not even so much banks in the traditional leasing arms. It's almost a high net worth individual being able to, say, tap a line of credit that has nothing to do with the aircraft itself, but it's some sort of other recourse line over here that they can draw from. And so we've definitely seen that get in the way of us growing our portfolio.
I think it's not the question of is it better or the one or the other, cash versus financing. I think it should suit for the customer and the situation of the customer. So the entire holistic situation of the customer, and there it could be that the customer A is, for him it's more suitable and more better than to use it from the cash, but also for the other one, this doesn't mean that it's the same.
Yeah, I think somewhere down the chain, every aircraft's getting financed. It's just whether or not it has a lien on it. But somewhere down the chain, whether it's through a bank line or otherwise, every asset on some level has probably got some sort of cost of capital to it.
Agreed.
Do you, Shawn, how competitive you're a global lender. How competitive is the US at the moment for that market? If the US corporates looking for aircraft finance or a high net worth, they've got lots of offers, haven't they?
Yeah, look, very competitive, and it's a function of established banking relationships that these credits, these obligors have. The question is, we underwrite a significant amount of corporate credits in the U.S. That's been established because of the value proposition that Global Jet brings to the table, which is as much around this is something that typically the average corporate obligor or high net worth obligor does every 6 or 7 years. That ownership timeline has now been extended beyond the traditional 5 years. They typically do it on one asset at a time. We have 200 plus assets in our book to spread that risk across. And so for somebody for whom that value proposition makes sense and they want a lender who truly understands the asset, and that's what we do and that's all that we do, the value proposition comes through. But make no mistake about it, it's highly competitive and there's no shortage of access to low-cost, cheap money via those institutions who can provide depositors, cash in the form of the loan. Well, that's not the game that we play in.
And internationally, how competitive do you see? Actually, Emma, how competitive is Eastern Europe? How many banks are you typically competing against on an aircraft deal?
I think you distinguish very well when you were asking, because first you were asking for the global, and then you were saying, okay, let's talk about the US. I think the competition globally, I mean, needless to say, is there. But we have to consider what is the footprint and what is the aim of the single market players. So we, an example, as UniCredit, we have some geographical footprint, we have an aim on special customers, we have an aim on special structures. So this is giving everyone an own framework. Still, in this own framework, you have, of course, also different market players, and we come across, but there are, let's say, the good market players, and we appreciate them, so that you can also, it gives a constructive market situation. So you can learn even from them, or how to do business, or even how not to do business. So on the other hand, an example, the US, we are not so coming across an example, we are not overlapping. So therefore everyone is finding somehow his turf and concentrate on the competition in this turf.
I think I'm always astonished at how many banks in the US do aircraft finance. You know, we're talking at least 100. And I think if you're a corporate looking for an aircraft finance or a high net worth, in the US, you've got so much more range. And I'm guessing that, you know, a Central Eastern European buyer, maybe 5 options of finance, you know, depending on country. If you're Romania, maybe 1 or 2.
Yes, you are fully right, especially in times where, let's say, banking services and the returns on banking services are very low. So everyone, even without a track record, is looking into what can I do? Yeah, there is so much liquidity. So there are also players coming and doing something. I would not say we are starting an El Dorado again, but still also there are, let's say, uncertainties by this market players, but we try not to, compare ourselves with them.
Yeah, there might be 100 banks in the U.S. looking for or offering financing, but the number of people in the U.S. looking for financing is far greater than it is in Eastern Europe or in Romania, for example. So I think the market is somewhat efficient, right? If there is an attractive way to deploy capital, people are going to go to that market to do it, particularly in the environment we're in, where everyone's been chasing yields down or spreads down while rates are rising.
Yeah, just one comment on that. There may be 100 banks, but very often you're only dealing with 5 or 6 institutions that do this with any regularity. And what we found in our experience is some of the regional banks, the smaller banks that offer this, do 1, 2, or 3 assets, and then they've determined that it's not an asset that they've got specialty expertise on, and they get in and they get out. And it's not uncommon for us to ultimately end up in a conversation where we acquire some of those assets.
Okay, here's a question about personal guarantees and corporate guarantees. When are we going to see alternative ways of financing aircraft that don't require personal guarantees or corporate guarantees, putting operational responsibility on the high net worth or corporate?
I mean, we've been there for some time, I think. At least when we were getting into the business in Guggenheim, it was almost exclusively what we call a limited recourse structure. So there are certain things that could trigger full recourse, but ultimately we were treating the asset as the credit itself. And I'd say in general, particularly outside the US, that still needs to be our underwriting standard. Because at the end of the day, if I have to go into a courtroom in Indonesia to enforce my rights and protect my capital, then I failed relative to being able to grab the collateral and just liquidate the aircraft and not really touch the belt and the suspenders that a personal guarantee would bring. It doesn't mean we don't get them in certain transactions, but it's certainly not where we lead our credit process.
I fully agree on that. So it's actually different approaches, of course, especially in the private banking sector. There you have players who are, an example, concentrating more on the corporate side, some more on the, let's say, wealth management family office side. But this is okay. So it's if my customer is demanding both different products, and I can combine and tailor-made and bring a structure which is in line, then it's fine. But I think it should not be a side product which I use as an enabler for the other one. This I see, or my observation is that this can bring difficulties. So if I say to the customer, look, you do A, because otherwise you will not get B. So, but if naturally you can combine and it's tailoring somehow and fitting for the customer, I think then it's fine.
Yeah, we focus on super mid-size and above aircraft, and our typical high net worth client has a net worth approaching $500 million, and they're looking for LTVs that require personal guarantees, corporate guarantees. So we're credit-led in our process, but we're dealing with a caliber and quality of obligor for whom that's not necessarily or ever an issue, because they value the other elements of the structured financing that we can provide them.
Which is actually separating our approaches. This is absolutely one approach, and the other one, what we are following is that we say we are an asset financer. So we concentrate on the asset. Of course, the creditworthiness of the customer is important, but for the installments, not for the entire value of the aircraft.
So we've got a question which I think I can predict that none of you is going to want to answer. What are the highest and lowest rate deals that you wrote in 2018? This is a great way to offend people when they realize they did the highest. But are we seeing rates getting tighter and loan-to-values getting higher, genuinely, in the market?
Probably generally, but my answer to that question is actually quite simple. It depends on where in the world we're competing. And if you're addressing a U.S. corporate guarantor, obligor, okay, versus an ultra-high net worth person necessarily outside of the U.S., okay, those are two very different ends of the spectrum, and they appreciate and understand that, and you underwrite to the same high standards, but rate reflects the appropriate structured solution.
I mean, both of our costs of capital are relatively public. We're both issuing term securitizations. So I'd say in general, we're trying to be 400 basis points above that. So I'll let you guys go research what that means on the whole. But I think that it's a combination of, sure, we're going out with high rates, that help us hit our equity rate of return, but we're also trying to set up transactions to succeed. So it's not necessarily, go get 10% because someone says they will pay it. You start having to ask the question, why? What does that mean? And be thoughtful in that way. But I'd say that it's not really about high and low. It's about, does this fit within our P&L? Does this help us hit our equity rate of return? And in a rising rate environment, expect those to continue to creep up and to be passed through.
I mean, beside the expectation of the customer regarding the rate, there's also the expectation on our side. Of course, we set our expectation as well, not as us, in us, also from our important stakeholders and shareholders. I mean, we have a clear, let's say, framework where the expectations in our direction are all really clearly set. So that means, we have a framework, we have, let's say, a range where we have the room for maneuver. And if something is out of this maneuver, we are not interested to go in this battle because we have a customer base who is firstly appreciating and secondly also understanding the, let's say, the fair value and the price we are offering. So therefore, I think it's more the question, would you like to go in this battle? And at the end, nobody will win on that.
Talking about rates, in the commercial aircraft finance market, banks have always moaned about export credit agencies lowering rates and do you guys, as asset lenders, look out and see Jim and Ford and your colleagues from Credit Suisse and UBS and think you guys ruin the market for us? No, I think we're offering something different, right? I think as someone who wanted to borrow $40 million to buy a G650 from us is going to get a $40 million loan. Somebody that wants to borrow $40 million in a private bank context might only be getting a
$15 million loan, depending on how much capital they have to have at the bank. Now, if they're being lent their own money, that's fine. That's a pretty rational approach to financing, particularly in North America and developed Europe. For someone outside of those regions that might be newer to wealth and maybe not so trusting of a single financial institution, we're offering an alternative. If they say no and go down that route, you know what, that's fine. But I think that at the end, as sort of Shawn said, you want customers that really value what you bring to the table. The deals we get done, we're not at the finish line with someone being like, the advance isn't enough, the amortization's too great, the fee's too high, the rate's too high. It's, okay, thanks a lot for helping us get this done. If they want to pay me 8%, maybe they're getting 16 or 20% in their business. So my 8% without as many guarantees and without as many restrictions on them, all of a sudden becomes a very valuable piece of paper.
When you're working on an operating lease, how are you making your residual assumptions? It's a question that Thomas was asked about. Mm-hmm. And also, are owners happy? Have owners already forgotten the downturn? Well, what happened in 2010, or how do you have that conversation?
Well, look, one of the real value propositions that existed in the decision to acquire the business that we acquired was because of the team that was able to come with it, who, arguably lived through, the lost decade, as it's been referred to. It's also been pointed out that there's some 2,200 plus discrete aircraft transactions on an annual basis. There is a high degree of transparency around the price points at which these aircraft trade. We have a team dedicated to tracking that every single day. We have an asset management team that deals with the disposal of those aircraft coming off of our leases. So we really have a very close watch on a daily, weekly, monthly basis that we track across all assets. And, we do the appropriate modeling to understand what future values would look like, in and out of a variety of economic environments. Because let's face it, what you're going to recognize in a residual value will have an awful lot to do with the spot market at that time, 5 years, 7 years, 8 years, 10 years hence. One of the things that advantages Global Jet Capital in this is that we deploy a significant number of the assets that come off lease onto another lease. That is part of the business that we have developed. So we get very focused on it. We make the appropriate conservative valuation. And sometimes we lose business because of it, but that's okay. But we're valuing for the long term, and we monitor it regularly.
Very carefully. I think in a revenue-generating asset circumstance like the VistaJet global fleet, I think 25 years to zero is a reasonable assumption, and it's actually a common accounting assumption on the commercial aircraft commercial aircraft world. I think for us, operating leases are really expensive to do with us. I think we feel like in a vacuum, you can always repurpose an airplane, but we take an approach. If I were to think about our operating lease portfolio on the whole, we probably at the end of the current terms will have an average useful life of somewhere between 15 and 18 years left on the assets, and our booked residuals will be, with a 2 in front of it as far as a percentage of the residual value from the original equipment cost. Now, it does a couple things. One, it affords us to not have to see into the future 6, 7, 8, 9 years from now, which if we really knew where values were going to be, or at least if I did, I don't know if I'd be up on stage and talking to all of you about it. But what I think it also allows us is, we get a lease payment, we get to choose how to book it onto book it and how to run it through our P&L. And at the end of the day, I think we are probably erring on the side of taking a little lower return today and potentially recapturing something down the line than running a higher return today and then having to restate something in the future. So it's a delicate balance.
I would like to pick up a comment from Shawn. He was saying, when he was explaining his approach, sometimes then we are losing also some deals, and this is good, so I fully agree. It needs much more courage not to do some deals instead of doing some deals. I think it's very important that you have a clear understanding what you want and how you want. What we are doing is, of course, and this is also distinguishing, I think, the market players who are since a long time in the market, in the good and in the bad times. They have a track record and they have a history, and this is also how we are following on that. So we are trying to use our own experience, but I mean, the industry is full with really great, important knowledge players. So we are also taking them in a combination. It's an inside know-how and it's an outside know-how. And then to bring that in a balance and to find for yourself then what would be the strategy.
So, Shawn, you were an OEM, or you worked as an OEM for a long time. What's your policy now on what OEMs are doing to protect residuals? Are you, what do you?
I'm sorry, what's their policy?
How do you? How do you think OEMs are doing at protecting residual values at the moment? How would you score them?
Right, disclaimer, right? Lifelong in the OEMs, right? I think it's important that we recognize within our industry that absolutely nothing happens in this industry for anybody in this room if an airplane doesn't get built. And that is a remarkably challenging job. And it is a bet the farm environment. You do not place bets at $800 million to $1 billion to $1.2 billion for a new program, okay, and make that decision lightly. So, their challenge in managing residual values isn't necessarily what they wake up every day thinking about. Their challenge is managing to market demand and managing supply versus that demand, and then articulating, right, a production plan that allows them to meet that and not oversupply it. And we all know what happened in 08, 09, and 10, okay? The fact that it has taken this long to manage production rates to the level that they are currently at is an indication of how hard that is to do, especially if you're a publicly traded entity, okay? Walking in and advising the analysts that your earnings per share are going to be off considerably over the next 2 to 3 years as a result of a production cut is not for the faint of heart. So that gets done over time. So what are they doing? I think they're doing a superb job, and they're doing it through managing the production rates. Now, if I could see one other improvement, it would be that there is, in my estimation, too many offerings from each OEM across the variety of models and capabilities. And I'm not suggesting we go back to what it was like 30 years ago, right, where it was easily segmented. Okay, those days are gone. But there is far too much choice that does exactly the same thing from every one of the OEMs in many respects. And I still respect the differentiation that exists, but the fact is the fact that if you're a buyer, you can get what you need from almost anybody, and that differentiation can be challenging to make.
I think it would be too easy to push the topic of the residual values to the OEMs. Of course, they are somehow a big influencer, but I strongly believe that all of the different market players, it doesn't matter at what part of the value chain, they have also somehow influence on the residual values, especially if we look on the secondary market. So the behavior on the different market players is also somehow influencing. Therefore, I strongly believe that it's the responsibility of all of us and all different market players, not just the OEMs, that the residual values are staying in a correct and on a stable level.
The OEMs in the front room are looking happy. Front row, sorry, not front room. Nick, do you want to thoughts?
Yeah, I think it's our responsibility to protect residual values more than the OEMs. I think we are aligned and we are all one industry, but as Shawn really noted, you've got publicly traded entities that have to make numbers. You also have a supply chain where 70 to 75% of a business aircraft is actually provided, the parts are provided by even another party, a lot of whom are also publicly traded. So the idea of production cuts is it's a long road, but at the end of the day, look, we can make the decision whether or not to finance a transaction or not, and so we have to, I think, police ourselves more than anything else.
Okay, we have a question from the audience. Does the panel prefer to use bankruptcy remote structures, or are you happy to use borrower entities wholly owned by the high net worth individual?
Bankruptcy remote is certainly preferred.
Agree.
Same.
Okay. What Any questions from the audience or comments? What's the thing that worries you most when you're thinking of your portfolio, in the bath or when you're going to bed? What's the thing that worries you most?
I often do take baths, so I worry a lot. It's actually not macro economic. It's not so much geopolitical. I think the things that worry me in the portfolio are very micro. It's, do we have an asset maybe we've over-advanced on, or, market's kind of gone south since we did the deal, and our collateral position's not quite where we want to be, and then we get a phone call that, there was a microburst, and, a cargo pallet, swung and hit the aircraft, and we can fix it, insurance covers it, but now you've got a 15% diminution of value, and all of a sudden that collateral position disappeared overnight. Those are the things that I worry about, because it's the things that you're not really underwriting to. And it's the things, the accidents or the mistakes that happen, that can happen really. We tend to think, if we have an aircraft based in Africa, or if we have an aircraft based in Southeast Asia, where people, airport operations may not be as evolved as, you'd like them here in the US, that's a risk. But I will tell you, you hear more about these things happening at Teterboro, happening at Van Nuys, at busy airports with airplanes that are parked close together. And so those are the things I think we worry about the most, because hopefully if we've done our job in underwriting, we realize that we're not managing cycle. We have to manage through 7 and 8 year cycles, and we have to assume the worst. And by assuming the worst, hopefully, whatever news comes to us in the next 6, 9, or 12 months, we'll kind of sit back and hopefully our portfolios will perform as planned.
We are talking a lot of transformation, changing process, changing environment, digitalization, also in this industry, but also in every other industry. I think that the change, or the matter of change, is not the question anymore. It's more the frequency of the change, which is becoming shorter and shorter and shorter. So that means that what is valid today is not anymore valid tomorrow. And especially if you consider that these things or events are not triggered by you or by your customer, even by a certain person, which is actually in the first moment maybe totally irrelevant, but becomes then so huge impact and so much influence, so that it's impacting you dramatically. So from my point of view, the frequency is becoming really shorter and shorter and shorter, and this makes us really somehow in a difficult environment to adapt and to adapt.
As I said earlier, because we're credit-led and the deals are structured with the appropriate guarantees, and we have a very experienced asset management group that monitors these assets on a regular basis, those are not the issues. Our default rate is exceptionally low, and it's a testament to the work of the underwriting team. I am at the other end of the spectrum on the macro, actually. I look at what is taking place on a geopolitical basis right now, and what I worry is, do we end up truly talking ourselves into a destabilized recessionary period? And given the latitude that some of the world's bad actors are being allowed to exercise these days, I don't think we should be complacent in misinterpreting that conflict can happen. And I will tell you, if conflict happens between any of the named large powers, things are going to change in a real big hurry. And unfortunately, the level of statesmanship being exhibited, and I'll limit my political commentary to that, is at a deplorable level, and hopefully that'll improve. And if it does, I think we get through this period and the world returns to a place where confidence can continue. But I think we're awfully close to an erosion of confidence.
Okay, I'm going to give you a choice. You can either answer this question, or we can go to tea, afternoon tea.
My least favorite plan? Sure, I'll be happy to answer that with absent one attribution. Remarkably uninterested in an aged asset, not in an engine program, to a credit that shouldn't be trying to own an airplane.
So what's your least favorite plane to finance, or would you like to go for tea?
Tea sounds wonderful.
Thank you very much to the panel.
All right, thank you.